Long-awaited Adobe earnings released today. Stock is up 2.5% after hours, almost broke even actually. Obviously down 4% in the normal trading session, just off of a very bad day in general for the entire market, where the Dow fell around 7%. So nothing too crazy, but you do like to see a little bit of recovery after hour. At one point it was around 5% higher, but we'll take a look at these earnings and see why it's up. So my anticipation here was relatively accurate on this aspect. So EPS of $2.45 beat by 13 cents. A GAAP EPS of $2.27 beat by 16. So overall nice on that aspect of beat. I expected an inline number on this. So this beat is pretty exciting for me at least. I like that. From a revenue perspective, I was expecting anywhere from a 10 to 15% growth year over year, which is a wide range, but I expected the upper end of that. And you know what? Revenue of $3.13 billion, up 14.2% year over year, missed by $30 million, and that's off upwards revised guidance as well there. So pretty nice, all things considered. Good to see that. Over 10%. I mean, you're talking about a double-digit increase year over year is very nice to see. Digital media revenue was 2.23 versus a consensus of 2.25. We'll look at these some of the fine details. So, total sales were up 14%. Digital media grew 18%, which included $1.87 billion in creative revenue and $360 in document cloud sales. Digital media annualized recurring revenue was $9.17 billion versus a consensus of $9.1. And again, I mentioned recurring revenue is the key for this company. When I was talking about this earnings prior, I expected really recurring revenue is important. It's about the subscriptions that they offer, both off of obviously stuff like PDFs, any Adobe products. It's really subscription based, all things considered. And that recurring revenue is important. $9.17 billion in recurring revenue is nice. Digital experience was up 5% year over year. Adobe sees for next quarter here, they're expecting total revenue of 3.15 versus the consensus of 3.28. So lower than consensus is not necessarily what I expected. I didn't expect them to really have weak guidance. An EPS of 240 versus a consensus of 247. Don't mind that B right there. They typoed just a little bit here. But definitely not what I expected. I didn't expect lower guidance than what the consensus previously was. So that's interesting to see on that aspect. I do think they'll beat that guidance. Digital media revenue is expected to grow 16% and experiences is expected to be flat. Okay, then let's look at this press release, see what we have to offer there. So record quarterly revenue, pretty nice to see on that aspect. You do like that. So digital media, you do love seeing that. Digital media annualized recurring revenue, $9.17 billion. That's the number we really like to see. Quarter over quarter increased $443 million. So that's quite a good addition to subscribers to their platforms. Honestly, very nice. And creative average recurring revenue to $7.93 billion, and document cloud average recurring revenue of $1.12. That's a really combination there, so good to see that. Digital experiences was 5% growth. Digital experience subscriptions revenue was up $707 million, which was an 8% increase year over year. And digital experience subscription revenue, excluding advertising cloud, grew 18%. So advertising cloud revenue obviously down, and it's not unexpected by any means when we talk about ad rates falling. It's just another aspect of their business that kind of took a little bit of a hit. But overall, still a growth in the segment's pretty nice to see. And that's probably why for the next quarter they're expecting a flat in terms of this aspect, is because they don't expect ad rates to be fully recovered yet. That's my expectations. I believe that the digital experience category alone, if you exclude advertising revenue, will be good growth year over year as well when we're talking about next quarter. But if we're talking about, overall, if you're including advertising cloud, you're going to see flat or a decrease probably just because of how ad rates are still going to be hit in the interim period, right? We're still going to have at least a month and a half of the quarter pretty well, significantly impacted in terms of ad rates. So, GAAP operating income was 1.02 billion. 1 billion is a nice number. Non-GAAP was 1.3. GAAP net income, which I like the net income line, was 1.1 billion. Love to see that. Cash flows was 1.18 billion. Heck yes, you do like to see that. Adding 1.18 billion to the balance sheet right away is nice, especially when you think about this company. This quarter brought in $3 billion of revenue. To bring in $1.18 billion of cash flow it's beautiful. That's a beautiful number. And if you don't think so, you're losing your mind. This is peak tech company levels there. We're talking about very good margin. I love it. Remaining performance obligation exiting the quarter was 9.92 billion, and Adobe repurchased 2.6 million shares during the quarter, which is hopefully at a lower level because of the stock seeing quite a decent run up. So, very big thing as far as our advertising cloud. It's given the macroeconomic environment. It's significantly accelerating Q2. It previously stated a strategy of low margin advertising cloud transaction driven offerings. The company will continue to offer its advertising cloud software solutions. The macroeconomic environment and the strategic shift impacted advertising cloud targeted revenue in Q2 by approximately 50 million. Not actually that big, all things considered. People aren't necessarily looking for the product, but if they're already subscribed, I don't know if they'll necessarily cancel, if you know what I'm talking about. So, we saw this guidance here as far as what that's expecting. So, nothing crazy that I have to add to that. Guidance I think was light. I don't know. It's a little bit light. What can I say? They should have the balance sheet on here for me because that's really what I want to look at. Oh, and heck, yes, they do. So total current assets on this company of 6.6 billion, and that is versus we're comparing this to 6 months ago. So good 6 months over year-over-year comparison. 6 months is nice. I prefer year-over-year, but that's fine. Versus 6.4 of 6 months ago, so good improvement there. Total assets as a whole, 21.6 billion versus 20.7 of a year ago, so $1 billion increase in assets is nice. Total current liabilities of 5.1 versus 8.1 6 months ago, so you see good pay down of those debts. And a lot of that, you can see it expressly here in this debt line. This was short-term debt that they had to pay off. There was long-term debt that was expiring. They had to finally pay it off, and that got paid off. That's a good, really just relief of burden there. Now, overall, they have increased long-term debt in the short term, though, as you'll see, $4.1 billion of long-term debt where they originally only had $1 billion. So, increase there. It really outweighs what they did as far as the current liabilities is concerned, but total liabilities in general, 10.7 versus 10.2 of a year ago, so a little bit of an increase, but you saw overall a bigger increase in assets, so I like that. Total equity for stock or shareholders of 10.8 billion is beautiful in my perspective when you're talking about having twice the assets that you do in terms of liabilities and cash flow being at a very good point even during pandemic levels. I'm very impressed with what this company can do. Absolutely. So the balance sheet's beautiful on this company, and I think the only concern you can really have for this company is going to be in valuation. Now, is this a company that deserves higher valuation because of the fact that it's doing so well? You could maybe say that's potentially the case. When the whole market's pretty highly priced, investors might keep their money in a stock like this, and it might not face the beatdown that other stocks might receive in the short term. I don't think these are necessarily great buy levels right now, though. If we're talking about the $400 range is where it's at right now. After hours, I don't know where it'll open necessarily, but it should be up. I think your much better buy levels are obviously, we're talking about all-time highs for the stock. Your much better buy levels, I think, would be under 350. Now, I think even under 350, the valuation's still a little bit expensive, but I think you're better off in that. This is a long-term play, though, Adobe is. So if you're willing to wait it out, I think Adobe's a very good long-term play for you, and they have a lot to offer. Very good company. They've got a lot to offer you. I'd say go ahead if you're interested in Adobe. It's not the best time necessarily. I'd wait for it to dip down the market. Hopefully, I'm anticipating a bigger dip down in the market than what we saw. Not a massive one, but I don't think it's time to buy Adobe. But I do love the company quite a bit.